Hey, everybody. On today's episode, Paul and I really drilled down into what the traits are of people who are highly successful at practicing the infinite banking concept. So, a lot of it revolves around Nelson's principles, of course, and we hit on that. And, one of the things that's come up recently that we hit on as well towards the end of the podcast is the all or nothing side to IBC, where a lot of people may view it as the end all be all, the only thing they need to be doing, and others view it as just one part of what they are doing with their total wealth picture in their portfolio. So Paul and I give our thoughts on that debate as well. So hope you guys enjoy this. Hey, I'm Dave.
And I'm Paul.
And this is the Wealth Warehouse Podcast. All right, Paul, how's your week going, man? Or how's it been, I guess? It's at the end of the week for us now, recording.
Yeah, pretty good. I did, I am all but cleared out of the Army. I'm waiting on one employee to send me this form where you opt out of the survivor benefit program. Tammy had to get that document notarized yesterday.
Yep.
Even though she can digitally sign it with her full bird colonel ID.
Well, then don't you have to sign hers? Also,
I will have to sign.
spouse?
Yes, I'll have to sign hers as the spouse, as the dependa, as I will become here in a few days or a few weeks.
Yeah.
But anyway, so I'm waiting on one thing. I was supposed to find out today. It's not gonna happen. So probably Monday or Tuesday. Getting a hold of these people is almost impossible. Multiple emails, like it's. There's definitely a systemic process problem. Anyway, all good.
Yeah.
Doesn't matter. I've got retirement orders. It will happen.
Yep.
But,
It'll all be in the rear view mirror.
Yeah, it's been a good week though. It's the weather's still crappy. How about up your way?
Yeah, I mean the kids were all out of school for an extra day this week because of the cold. It was too cold to wait at the bus stop.
Yeah.
So,
and I know our listeners know this, but I hope other people start to realize like we can handle, an increase of 1 degree Celsius. What we wouldn't be able to handle is a decrease of temperature, like an ice age, right? As human beings.
Yeah, that'd be brutal.
That would be worse than 1 degree Celsius warmer.
Yeah.
Anyway.
In 100 years or something like that.
Right.
Yeah. Yep, I'm with you. All right, man. Well, so we want to talk today about kind of hitting back. It's a little bit of back to the basics, but really what we want to talk about is what makes somebody successful at utilizing the infinite banking concept. Like with all of our clients, who are the people that caught on the quickest and are doing the most with it, or making where IBC is having the biggest impact in their lives? And really, it all goes back to Nelson's principles. So we can just hit those one at a time here, I think.
Yeah, absolutely.
Yeah.
So numero uno, think long range.
Yep. Think long range.
And what Nelson meant was think beyond your generation. Think generationally. And then, of course, he talks about, being a forester and harvesting trees, doing improvement cuttings, and, having an equal distribution of age classes, right? Anyway, so think long range. And, before we hit record, you reminded me to bring up something. And this comes up sometimes. And I always like to explain this, like the base versus PUA total premium, right? So if you're paying, let's say, $25,000 of total scheduled premium, right? Or illustrated premium is probably a better word. And let's say half of that is base and half of that is PUA, just for simple math. That means your premium is really only $12,500.
Right.
Right.
Why is it only $12,500?
Because you only are required to pay your base premium to keep the policy in force. Now, you should endeavor, of course, to pay that PUA rider as well, the PUA premium. But you're not obliged. You don't have to. You should, obviously. So, just keep that in mind as you're going through the process. The initial premium number might have some shock value. You're like, whoa, wow, that's a lot of premium. And it is, because you don't know nobody else paying that much premium. But we know hundreds of people paying high premium relative to their income. So it's not really a big deal to us. It's just we know what it takes to properly practice the infinite banking concept, and we're going to recommend a premium that makes sense for your current situation.
Yeah, exactly. So good. I mean, thinking long range, there's so much to that. And if you can't get over the first few years, because let's face it, there's an opportunity. I guess you could call it an opportunity cost, but there's a sacrifice in the first few years of liquidity, not having 100% liquidity from what you've paid in, which just makes sense. You're getting something in return, right? You're getting permanent death benefit
Right.
that's going to go up every year. But if you only focus on that, that's why I love, when I review these with people who, once they get approved, we review the policy. And we go to the year by year numbers and say, hey, here's the projection. Here's what it looks like in the first few years. You take a hit. Now let's scroll down. What age do you want to stop working? 60, 65. Okay, what does this look like at that point? And you see the difference at that point, which is kind of thinking long range. If you're a younger person, 20 or 30 years away is kind of long range. Not as long as we should be thinking, but that's fairly long range. And they see, man, at retirement, every dollar I pay in premium is creating how many dollars for me in cash value that year? Like it could be significant. So,
Yep.
don't get caught up in just the first few years. You got to look long range.
Yeah, it's simply, as you said, it's a temporary loss of liquidity. But for most people, Dave, they've been socking money in a place like a 401k or an IRA, which they can't get to anyway. And now they're putting
Right.
those dollars maybe here, where they can get to a good portion of it right away. So
Right. Which
not
makes
a
all
big
the
deal.
difference in the world to somebody like our guest last week,
Yes.
Scott, who was our guest and talked about how having access to that capital made all the difference in the world once he was out of the Army.
Yes.
Yeah.
Yep.
All right. Next one. Don't be afraid to capitalize. So this is one. I mean, go back to episode 93. How much premium should I pay? That's one everybody should listen to, before they finalize their premium. But don't be afraid to capitalize. How many people have come to you within a year and said, "Hey, I'm thinking about doing another policy," and I'm like, "Well, did your income dramatically increase?" No, I'm making the same as I was when we started my first one. I just didn't do enough. I was afraid to capitalize. That's what they're saying without saying it. But
Yep. No, absolutely. I've had clients double their premium in 6 months.
yep,
They do the dip your toe in and then realize they get into, what I find is they start to rethink their thinking. They get into something else. Maybe they became interested in real estate investing or something, and they start actually participating in meetups and masterminds and things like that. Kind of like you did back in the day, single family flip, mastermind, and they become maybe adept at it, do some underwriting, and they find, well, I want to invest in this deal, but I don't have the capital to do it, but I've got all this capital over here that I've been locking up for the last 20 years of my career. And it just dawns on them.
yeah,
I need to, just like it dawned on Nelson, I need to increase my premium.
yep,
And here we are. And that person that I'm thinking of, so I'll give a shout out, Chris, is going on his third policy. He just came back approved again. And this is, he's been my client for what, 3-4 years now. And policy number 3, plus a convertible term. So this will be his fourth policy.
yeah. There you go. Well done.
Yep.
That's great. Well, the next one, don't steal the peas. This is the one that I think probably confuses people the most, and they have to reread
Peas.
the story. Like,
Yeah.
what does that mean? Really, it comes down to playing honest banker. Be an honest banker with yourself, right?
Yes.
Don't take loans and not pay them back. Don't treat it like a piggy bank. It's not a piggy bank. It's your personal bank. You got to think of it like your own business. Would you steal from your own business and never put capital back into it? I'd say if you did, you wouldn't have a business for very long. And it could be the same thing with your policy. You could create some situations that are not good for you if you never pay those loans back.
Right. Like, do not follow the lead of our federal government, right? Who can now barely make the interest payments on the debt. you know,
Right.
Print more money and pay the loan with it. All right, great. But no, great point. You should never take a policy loan that you haven't made provisions or of repayment. It's as simple as that.
Yeah. And there may be exceptions for later on in life, those passive income years where you create the
That's a good
illustration
point.
that shows how much can I take out and not pay it back because I've got a ton of death benefit. They can just remove it from my death benefit after I'm gone.
Yeah. No, you bring up a great point. Obviously, later in life, the older a policy is and the more premium it's accepted, the more flexibility and performance that policy is going to have for you. So, yes, no question.
Yeah. All right. What about the next one? Don't do business with banks. Is Nelson saying don't ever use a bank for anything?
No. I mean, I suppose a strict interpretation of that would mean outside of checking or savings where you can just transact banking, he would, maybe say no. But I think the way I like to put it is the banker, in this case, me or you or a client or somebody, so you, listener, you can do whatever you want. It may be, and we've had examples on the podcast where I was actually talking to another client yesterday who got $2,000 off the MSRP of his vehicle just by sitting down with the finance manager at the dealership. And yeah, I mean, just there you go. He already had the funds and knew how he was going to pay for it with life insurance, cash value, policy loan, but they didn't know that. And so he took advantage. And once again, and this was the what we talked about last night was like, he was able to go in a position of strength and walk out with a better deal than he otherwise could have got.
Yeah. Because he had access to capital.
Oh, because they also didn't have any financing options for him in his state or whatever it was. I'm not really sure the details, but.
Well, there you go. But don't do business with banks. The way I see it, like you said, the banker can do whatever he wants. Yeah. If it makes sense to maybe get a car loan as opposed to taking a cash value loan to go buy a car, you can make that decision to do that, knowing that I've got the capital available in my cash value that I can borrow against at any point and pay that bank loan off. Should that be the most productive use of my dollars at that time? Because that's our viewpoint.
Yep, absolutely.
Yeah. All right. And then, his final one is rethink your thinking. Now, what have we found lately? What have we run into with people?
Show me the numbers, or analysis paralysis, or another way that I've heard it is majoring in the minors. And you really have to go back to this book, go back to Becoming Your Own Banker, and really read it and really understand what Nelson is trying to get you to understand. And it's not about the numbers. It's not about investments. It's not about rates of return. It's not about interest rates. It's about building a private pool of capital so you can recapture interest that you otherwise been bleeding to the banks your entire life and finance companies and other entities, which he says, at the time was 34.5 cents out of every disposable dollar. So, which is a lot.
Yeah, which is probably pretty accurate still.
So right.
Yeah,
No doubt.
American is putting towards
and
interest.
It's even worse now because the dollar is so much weaker than it was in 2000, right? Just through the money printing and government spending. And but I would say that it's, I try to take people back to when I first read the books. I don't remember thinking about any of those things.
Yeah.
I remember thinking of, this is the mindset or the mindset that I want, but the strategy or the process and the product and all of it kind of binding together into, this is what I've been looking for. I want independence. I want freedom. This sounds perfect for me, this process, using whole life. And Nelson explains, you can practice IBC with anything. You can bank with anything, right? You can use a CD, you can use a savings account, you can use whatever. But the best way to do it is through participating whole life insurance issued through a mutual company. So, I don't know. I just focus on the right things, folks. We can make the illustration look any way you want it to look. They're your numbers, but they're just numbers on a page. The process of becoming your own banker, embracing the process, learning the process, refining your process, is the most important thing.
Yeah. Have you ever heard that analogy of like a big glass jar and you fill it up with, if you think of like big rocks versus pebbles, the things you should be focusing on, put those in
Yes.
first, the big stuff. Fill that up with the big stuff. And then there's room for the little things, the
Right.
details. So the big rocks would be Nelson's principles. Think long range. Make sure you understand what that means. Don't be afraid to capitalize. Don't steal the peas. Don't do business with banks and rethink your thinking. Those are like the big rocks that should fill that glass jar up. Then you can fill it up with the little pebbles, like which insurance company to use, what's the illustration look like, how much premium should I use, what's the loan rate, how do I repay a loan, that kind of stuff. And then there's the granular details. When you got all that in there, then you can add like sand and fill it up with even more. And those are the nitnoid things like, what's the internal rate of return? Who cares? Like these little nitnoid things that people start focusing on, those become the big rocks, and it jams up them being able to get in anything else into that glass jar. That they can't consider it anymore because they're focused on the tiny, minute details.
That's a great analogy. Yes, I think you've done that on the podcast before. It's spot on. It's you're just focused. I mean, you're focusing on the wrong things, right? You've got you're inverted right now. You're inverted like Maverick and Goose taking a Polaroid. You want to get to, you have to go back to the carrier and land. So you want to, roll and be, prepared to land, greasy side down, right? So, yeah, man, I can't put any better than that. It's spot on.
Yeah.
But I guess, why are they focusing on that stuff?
Because they don't know any better. I think the more you know, the more you learn, the more you understand, and the more you practice infinite banking, the less the details even matter. Like, I don't care. And I care less now than I did 15 years ago when I started on the details, because I realized it's not the details that matter. It was kind of like when I was in pilot training, and you fly with an instructor, the young instructor, the lieutenant, the guy who just went from graduating pilot training to becoming an instructor. He was focused on the details, and he would pick out every tiny little thing you did wrong.
Pilot training is so different.
Yeah. But then the experienced instructors, these guys who've been out in the combat air force, flying fighters, coming back after years and years and thousands of hours of flying.
Big things.
They're big picture. They're like,
Yeah.
hey, great, you didn't kill us. Great.
Yep.
You need to work on this and this. It was like 2 or 3 big things. That was it.
Right.
Not a list of 30 little minute, tiny little things like, oh, your wheel was off the taxi line by 3 inches. Like, focus on the things that matter. And that's really all you need. You'll learn the details along the way.
And if you don't know what's going on, the details don't matter anyway.
That's right.
Yeah.
Exactly. So,
And then I don't know where I came up with this next one, but bonus thing from Nelson Nash, I suppose. Be prepared for windfalls.
I kind of think that goes along with think long range.
Yeah. No,
Like,
it does.
Over the course of your life, what big windfalls do you expect? An inheritance, to sell your primary home and cash in on the appreciation? Where are you going to put that money? You might have a place for it if you have outstanding loans.
Give the listeners, an example. I just prepaid a policy on myself for the next decade, and anticipating some windfalls. I've got some other things going on, so I've got some policy loans out. But I know Tammy sold this house that I'm sitting in on Facebook Messenger, on a Facebook group, which is fantastic, right? So anyway, that's going to be a windfall when we move. Like around May, we're going to rent it back, and that's going to be a huge windfall for me that I'll replenish those policy loans, right? Maybe that pays for hopefully it pays for all of the pool and whatever else is around it, or landscaping or something. I don't know.
Yeah.
But yeah, I'm prepared to accept. I've got a place to put it.
Yeah, exactly. Nice. Well, some other things successful people do besides focusing on Nelson's principles are, when they explore this concept and educate themselves and get advice on it, they don't go to Uncle Joe to get advice. They're not going to go to their broke best friend to get advice. What do you think of whole life insurance? No, they're going to go to the source. They're going to go to legitimate professional sources and get advice. Read the right books, follow the right people, understand so your understanding isn't based on somebody else's misunderstanding.
Yeah, exactly right. I was explaining to someone the other day who was poo-pooing whole life insurance, and I just dropped J.C. Penney and Walt Disney's name off, and he's like, they got rich using life insurance? I was like, no, they got rich in their business, but they saved or grew their business
Or
when they
yeah,
needed
save their
to
business, right?
using cash value from their whole life insurance policies. And of course, nobody knows that, but you can look it up. It's out there,
Yeah,
and it's true. You can even ask ChatGPT, and it'll tell you that.
yeah,
Amazing.
absolutely. Something else successful people do, people who practice IBC with success, they focus on the process, not the product. I think that's where a lot of the analysis paralysis comes from, is focusing too much on the product of whole life insurance and not the process of banking, which, do any of those of Nelson's principles have anything to do or reference whole life insurance whatsoever? No.
No, nor is it in the title of the book.
Right.
The biggest word on here is banker
Yeah.
in, bright red letters.
Yeah.
It's
Exactly.
about banking.
Yep. And that's where almost 99.9% of people who rag on whole life insurance, they're focusing only on the product. Period. Don't even
Yep.
consider banking.
This is good that we're talking about this. This is giving me some ideas to send. I'm going to ask some just simple questions to some clients that I've got right now that I think are starting too small given their situation. So we'll see what they say. And then there's other people that want to pay more premium. They just don't have the means to. They're like, I totally get it, but this is as much as I can pay.
Yeah.
And that's awesome, right? They're further ahead in their journey, even though their premium level will be smaller.
Yeah. Exactly. But they'll be ready. As soon as they've got the means, they'll be ready to start a new one and expand their system.
Absolutely.
Yeah. People who practice this successfully understand that all money is borrowed money. So why don't you
Ooh,
explain that one?
man. You're always dealing with borrowed money. In fact, I think that's one of the fundamentals of IBC that you really need to reconcile in your brain. And of course, people are going to say, well, Paul, I paid cash for that thing. And we've talked about it many times on here. Yes, but now you've given up the earning potential of those dollars. So in essence, you have borrowed that money from yourself. You have to put a price on that capital, right? So I'll give you a real world example of how I'm going to treat my family banking system. When my children want to go buy something, I'm going to charge them higher than market interest rates because that's how much I value my capital. Right? I'm going
Yeah.
to charge them probably 10%. It's going to benefit them in the long run, and they know this, but that's an opportunity cost. I have an opportunity where I can earn 10% or 12%. Maybe 10% is the family discount. I don't know.
Yeah, right.
But, right? So that's what it means. That's how I look at it.
That's good. I remember there was a LinkedIn comment that I responded to recently where a guy who has whole life insurance and says he practices IBC, but he was basically, he said something along the lines of, I don't like to borrow against my cash value for investments because maybe my investment doesn't pay enough interest, in an interest rate that's higher than what I have to borrow the money at. And I'm thinking, well, yeah, that would be really stupid. So if you do borrow against your cash value, obviously you're going to go for better investments because there's a cost to your money, whether it's cash in the bank or it's your whole life insurance cash value. There's a cost to it. So why would you invest money for a 5% return? That's not a good use of your money right now
Right.
because
Yeah, you can get that in a savings account.
exactly.
And
So
it makes
why
no
put
sense
that
to
at
pull a
risk?
policy loan and
Yeah.
doesn't make any sense. Yeah.
So yeah, of course you need your investment return to be higher than what you're paying, than what your cost of money is, or it doesn't make sense. Therefore, there's a lot of investments that don't make sense for me anymore.
Correct.
You know?
That's
And
right.
I'm out of their league, I guess you could say.
Yeah, there's, and again, it's not like we're talking ridiculous returns, but as you mature and we've talked about getting older and wiser and more picky in where we deploy our capital, right? FOMO is non-existent in my. I could care less. There's these deals coming across the desk every week, and they're all what would have been super interesting to me in 2020 is mildly interesting to me now.
Yeah, it's got to be something. It's got to be a slam dunk for me to even care anymore.
Yeah, and that's folks. I think that's how you should start out. Don't feel like you're missing out on something. Not everything is an opportunity. Getting a little off topic, but I think it's an important point. Is that it needs to be, perfect slam dunk.
Yeah, right. Well, good. That's good. There's one other thing we should address that because it's come up recently. Is this mentality that people they research infinite banking, they read Nelson's book, and there's some things they just gloss over because this isn't what you should leave reading that book. It's not what you should come away with after reading the book. This all or nothing mentality that hey, it seems like to do infinite banking, I've got to do all or nothing, like put all of my eggs in the IBC basket and that's it. Not do any investing anywhere else. And maybe that's also how it's sold a little bit on YouTube, or marketed a little bit here and there. Mm-hmm. But not even Nelson believes that. I mean, we were just reading the book right before we hit record here. What, page 12. What did that talk about?
Yeah, I think that's the part where, let's see.
We're talking about what Nelson has invested in, or had invested in for years and years, basically his entire adult life.
Yeah, the title of that section is, How the Infinite Banking Concept Got Started. And,
and he talks about real estate investment.
Talks about real estate investing, right. And I would say I was going to your point, if you're one of these people suffering from analysis paralysis, go give these 2 pages a reread, and then continue on to imagination. Nelson talks about in that book how because he had access to capital, he was able to secure this piece of land, and then sold the piece of land, never laid eyes on it, and took the family to Europe for a month.
Yeah,
with the profits, right?
And that all originated because he had access to capital. That's essentially the origination point of any investment, any opportunity. Being successful at anything is having access to the capital.
That's right.
If you don't have access, you can't ever even participate in a good opportunity because you don't have access to capital.
Yep. So all that home equity that you have, can't spend it.
And how quickly can you access that capital is the second point.
That's absolutely right. And he says that, right? Like,
yeah,
he was able to. He rushed over to the State Farm agent or whatever, and was like, "Get me a check."
Yeah.
And gets the policy loan and is able to take advantage of that before the guy changes his mind, for selling it to him.
Yeah,
for,
right.
25 cents an egg, 25 cents on the dollar for what it was worth or something.
Yeah.
But that's how it works. Other people are undercapitalized. They get into situations. They need out. It's just like we talk about with business succession. If you don't have a good business succession plan, you're a partner, you're a buy-sell agreement that's funded by whole life insurance, there's potential there for that business to be in trouble when one of the partners dies. And I have a client whose parents are in that situation right now.
Yeah. Well, so we say it's not the only place you should put capital. But for us, it's the first place.
First place.
It's truly the first place I want to put as much capital as I can. And we've said it before, we don't have a single client who pays more premium, or actually probably even has more death benefit than either of us have.
Right? No, but we're looking for one.
But we're looking for you.
Or 100.
Yeah. Yeah.
No,
but
we have wonderful
place.
clients, though, don't we?
Yeah.
Wonderful clients.
Yep.
Don't care what your premium is.
No, it's really about how much relative to your income. That really is the determining factor in are you paying enough?
Yeah, and I think, the most important thing that you guys can do is just have the desire to become your own banker.
Yep.
That is ultimately the most important thing, and the rest will fall into place for you. Guarantee it.
There you go. The details, you can handle those as you go.
Yep.
So think big rocks. So, all right, everybody. All right, Paul. Good talk, buddy.
Hey, man.
Yeah. Well, you have a good week. We'll talk to you next week, man. Until then, everybody, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.